Hey everyone, it's Alan back again, and today we're going to be looking at 4 REITs or real estate investment trusts in particular that have a very long and dependable track record of increasing their dividends every single year. For more than 2 decades, the following REITs have increased their dividends at least once a year, every year without fail, even during the pandemic as well as the 2008 financial crisis. Under most circumstances, if a company is able to increase their dividends at least once every 12 months, it's usually a good indicator that a company has a great management team and that they have a lot of financial strength in their balance sheet. REITs are one of the best type of investments out there for people who are looking for passive income or just a really easy way to get into real estate investing. REITs own and/or manage income-producing real estate properties, and then they're required by law to pass 90% of their profits collected from tenants back to shareholders in the form of dividends. They're traded just like stocks, so they're super easy to invest in, and you don't have to worry about building maintenance, evicting tenants, and any of the other headaches that can happen with traditional real estate investing. Just like corporations, some REITs are better than others, and today we're going to look at 4 in particular that have a very long history of growth. 3 out of the 4 companies we're going to look at on this list are currently dividend aristocrats, along with one other that isn't quite there yet because they simply haven't been around long enough. If you're not familiar, a dividend aristocrat is a stock that's consistently increased their dividend every year for 25 consecutive years. Needless to say, being known as a dividend aristocrat is a very prestigious status that companies don't like to lose once they've attained it. Granted, it's still possible, but these REITs have long track records of excellent management and financial strength. So with that being said, let's get started. The first REIT on our list is WP Carey, ticker symbol WPC, which is one of the largest net lease REITs with an enterprise value of approximately $18 billion and a diversified portfolio of 1,215 properties covering approximately 142 million square feet as of September of last year. WP Carey's portfolio is located primarily in the US, as well as Northern and Western Europe, and it's well diversified by tenant, property type, geographic location, and tenant industry. WP Carey became a publicly traded company 22 years ago, all the way back in 1998, and since then they've increased their dividends every year. Because of this, they aren't quite yet a dividend aristocrat, but based on their ongoing performance, they're definitely on track to obtain that status in the next 3 years. Their stock is currently trading at $74.38 per share and offers a nice dividend yield of 5.57%. WPC stock price is up over 103% from this time 10 years ago. WP Carey's website is full of really good information in regards to their real estate portfolio. Currently, 98.3% of their properties are occupied, which is considered to be really good in the industry. And if we scroll down, we can see how well diversified their properties are. If you look on the right, you can see that the industry and warehouse makeup is roughly 47% of their total portfolio. These are really solid industries that typically hold their ground during bad economic times. Their top 10 tenants are also in some good recession-proof industries. As you can see, self-storage companies make up their number 1 and number 6 largest tenants. Self-storage spaces are always needed regardless of the economy. In times of plenty, people need more space to store their extra possessions, and in times of difficulty, people need a place to put their belongings when they get evicted. They also own 70 government offices in Spain, as well as school buildings, business-to-business wholesale stores, and industrial properties. They do own some hotels which are more impacted during bad economic times, but they fortunately only account for a very small percentage of their total real estate portfolio. Over on their investor relations page, we can see that they have a weighted average lease term of 10.6 years. That means the average client who rents one of WP Carey's properties gets locked into a roughly 10-year-long contract. The longer the average lease term, the safer a REIT typically is, because when you lock businesses into longer contracts, that usually means that you can depend on them to pay their rent for many years going forward. Overall, I think WP Carey has maintained a really solid track record, and they look to be in a very good position for future ongoing growth. The next REIT we're going to take a look at is Essex Property Trust, ticker symbol ESS. Essex is a fully integrated real estate investment trust that acquires, develops, redevelops, and manages upscale multifamily residential properties in selected West Coast markets, including the San Francisco Bay Area, Los Angeles, San Diego, as well as Seattle. Essex currently has ownership interests in 246 apartment communities comprising approximately of 60,000 apartment homes with an additional 6 properties in various stages of active development. Essex Property Trust officially became a dividend aristocrat last year after 25 consecutive years of dividend increases. Right now the stock is trading at $291.50, so it is pretty expensive, and it currently has a dividend yield of 2.85%, which is the lowest yielding dividend REIT on this list. Right now their stock is up over 117% from this time 10 years ago, and it currently pays a quarterly dividend of $2.09 per share. Unless you've been living under a rock or maybe you don't live in the United States, you're probably well aware that San Francisco, Los Angeles, and San Diego have some of the highest rents in the country. Upscale apartments in these markets are in very high demand. If you look at their website, you can see that a lot of their apartments go for over $2,000 a month for just a studio. Their apartment occupancy rate is at about 96%, which also is really good. One of the biggest criticisms of Essex I hear is their lack of property diversity in markets where people are leaving. You might also have heard about a so-called mass exodus out of the state of California, where most of Essex properties are located. While it's true that a lot of people have been moving out of the state, I think what gives Essex strength is the fact that their properties are tailored towards upper-class tenants. Personally, I really like apartment REITs because it's one of those industries that'll always be needed. Unlike hotel REITs, travel REITs, or mall REITs, apartments are always in demand, and Essex is one that stands out in the industry. Despite people moving out of their primary markets, I think Essex will be able to maintain their dividend growth in the future. Before we continue, if this video has provided you with any sort of benefit, I'd really appreciate it if you could click the thumbs up button below and also subscribe to the channel for more dividend investing strategy videos. Dividend Bull revolves around aggressive dividend investing where we focus a lot on REITs, BDCs, closed-end funds, and more with the goal of being able to live off dividends sooner. If that sounds appealing to you, feel free to subscribe, and thank you so much for your consideration. Next, we have a REIT that most people probably aren't strangers to, and that would be Realty Income, ticker symbol O. Known as the monthly dividend company, Realty Income is a REIT that's dedicated to providing shareholders with dependable monthly income. To date, the company has declared 608 consecutive common stock monthly dividends throughout its 52-year operating history and has increased the dividend 109 times since Realty Income's public listing in 1994. As you can probably guess, Realty Income pays dividends monthly, which makes them stand out among the other REITs on this list. Right now, Realty Income is trading at $68.21 per share, and it currently has a dividend yield of 4.08%. They currently pay a little over 23 cents per share a month in dividends, and right now their stock is up over 97% from this time 10 years ago. Realty Income is one of the most well-respected REITs out there and is probably the most well-known REIT. The company was designed specifically to provide investors with monthly dividends as opposed to quarterly. They actually have a nice little video on their LinkedIn page that goes into some more detail on their founding, and it's clear that providing dependable monthly dividends has always been their #1 goal. As of the making of this video, Realty Income has over 6,600 properties in their real estate investment portfolio in all 50 states, as well as in Puerto Rico and the UK. If we look at their top 20 clients, we can see that there's a lot of good companies on this list. Businesses like Walgreens, 7-Eleven, Dollar General, and FedEx are pretty solid companies that tend to fare well during most economic times. You'll also probably notice that Realty Income does own some properties that are more impacted during bad economic times, like movie theaters and gyms. I've been going through their reports on Edgar, which is the SEC's online database where investors can look up companies' quarterly and annual reports, among others, and based on what I'm seeing, it appears that Realty has been transitioning away from gyms and other types of properties that are less predictable during recessions and poor economic times, which is good. The last REIT we'll be looking at is Federal Realty Income Trust, ticker symbol FRT. Federal Realty is involved in the ownership, operation, and redevelopment of high-quality retail-based properties located primarily in major coastal markets from Washington, D.C. to Boston, as well as San Francisco and Los Angeles. Founded in 1962, Federal Realty's mission is to deliver long-term, sustainable growth through investing in densely populated, affluent communities where retail demand exceeds supply. FRT is currently trading at $112.92 per share, and it has a dividend yield of 3.73%. Federal Realty has consistently increased their dividends every year for the last 52 years. not only making them a dividend aristocrat, but also making them a dividend king, which is a company that has increased their dividends for at least 50 years. When looking at its performance, FRT is only up about 33% from this time 10 years ago. Their stock reached an all-time high back in 2016, and since then it hasn't been able to fully recover to that point. Additionally, Federal Realty is a REIT that's continued to struggle to recover to its pre-pandemic price. I suspect the biggest reason is due to the fact that shopping centers haven't fully recovered from the COVID pandemic. I think there's one thing that investors should keep in mind though, and that is Federal Realty doesn't just own shopping centers, they create mixed-use neighborhoods. We're all familiar with shopping malls and strip malls, but mixed-use shopping centers are different. They combine housing and retail space together. Usually you'll have upscale shopping centers and then you'll have like apartments or condos on top of those stores. These mixed-use neighborhoods are really popular and can charge a lot of money for rent. According to news reports, these upscale shopping centers like the ones that Federal Realty owns haven't been struggling nearly as much as middle and lower market shopping centers, which is another really good benefit for Federal Realty. While the pandemic has put pressure on Federal Realty, I think things are going to continue to get better as they continue to recover from the plunge back in March of 2020. Judging by their payout ratio, they still have room to continue to pay out and increase their dividends. They do have a very diverse portfolio of approximately 104 properties, which include 2,800 residential units, as well as some offices and strip malls. Okay everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. Like I mentioned earlier, if this video benefited you in any sort of way, please click the like button below and also click the subscribe button if you're interested in more aggressive dividend investing videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content. Alright, thanks again everyone, and I'll catch you next time. Take care.